This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. You know, I just watched The Big Short again, coming back from Tokyo to Washington Dulles. Such a great movie. Spot on. Awesome. And the Michael Burry character, right? They did such a great job. And I felt like, if I'm going to talk about the Yale endowment today, leading off with a little Bon Scott, right where I need to be. So the Yale endowment, the big chunk of change that Yale has, it's an interesting story. David Swensen, the guy who's managed it for decades. It's the creme de la creme. Fabulous. Exceptional. No one beats it. They've got top flight asset allocation, diversification. Everything's perfect. Now, they lost a significant chunk of change during the crisis. They've made it back. But then again, all index holders have made it back. Am I saying Yale is just an index? Not saying that yet. But I want to dig in today for Wall Street. This is another one of those hero worship situations. Yale, the assets under management, what is it, 25 billion? I mean, this is a massive fund. Fantastic success, except for the crisis. I'm holding in front of me the 2016 copy of the Yale Endowment. And I want to read some from it. I think this will put you in the headspace of what it takes to be the best. And then you're going to have to decide whether or not this is how the best think, or this is how one of the best operations describes itself, whether accurate or not. Chapter 3, Investment Policy. Yale's portfolio is structured using a combination of academic theory and informed market judgment. The theoretical framework relies on mean variance analysis, an approach developed by Nobel laureates James Tobin and Harry Markowitz, both of whom conducted work on this important portfolio management tool at Yale's Cowles Foundation. Using statistical techniques to combine expected returns, variances, and covariances of investment assets, Yale employs mean variance analysis to estimate estimated risk and return profiles of various asset allocation alternatives and to test sensitivity of results to changes in input assumptions. That sounds like standard operating procedure right from the finance textbooks. Continuing. Because investment management involves as much art as science, qualitative considerations play an extremely important role in portfolio decisions. The decision of an asset class is subjective, requiring precise distinctions where none exist. Returns and correlations are difficult to forecast. Historical data provide a guide, but must be modified to recognize structural changes and compensate for anomalous periods. Quantitative measures have difficulty incorporating factors such as market liquidity or the influence of significant low probability events. In spite of the operational challenges, the rigor required in conducting mean variance analysis brings an important perspective to the asset allocation process. End quote. Well, that's a mouthful there. I mean, it's laying out clear as day the returns that you can find with the Yale Endowment, the assets under management, the gains. This is art. This requires a wizard or wizards with specific artistic talents related to the market. Now, sometimes people call trend following black box. How the hell is the paragraph that I just read not black box? It's 100% black box. Some quick notes before I expand into an interview excerpt from the manager of the Yale Endowment. First, Harry Markowitz. Harry Markowitz laid out this scenario all those decades ago. But Harry did not put a style of investing out. He was simply talking about the mean variance analysis. He also later pointed out that things like the Sharpe ratio, where you don't measure upside volatility, where upside volatility is frankly penalized, is not so great. So when I read this from the Investment Policy, Chapter 3 of the Yale Endowment, are they being candid? Are they being straightforward, truthful with the work of Harry Markowitz? That's ultimately up for you to judge. But Harry's been pretty clear about how his work has been taken and used in a way that he did not lay out. It was not intended. He did not intend for his work to become the foundation of everyone being in a passive index. Am I saying the Yale Endowment is a passive index? Again, that's going to be up for you to judge. Everyone can run the correlations. And look, of course, the Yale Endowment has opportunities that you don't have. At their size, with their connections, they're going to get sweetheart deals that you will never, ever, ever come across. They will have opportunities you can't consider. In many ways, looking at their performance helps you how? Well, it doesn't really help you. What helps you is to analyze the words, to analyze the numbers, and try and make sense of it the best that you can. Because if anyone does a few Google searches on the Yale Endowment, David Swensen, this is rock star stuff. You want to be like him. Everyone should be like him. He's got it all figured out. But if I go back to the excerpt that I just read, to quote him, to quote the Yale Endowment, returns and correlations are difficult to forecast. Well, no kidding. They're not only difficult, they're impossible. So yes, I can sit here right now and I can look at the absolute returns of the Yale Endowment. I can see the money under management. But then I can look at their descriptions. Returns and correlations are difficult to forecast. Why say that? Why say something that's patently absurd? They're not difficult to forecast. They're impossible to forecast. Somebody can come back and they can take a whack at me and say, Mike, you don't understand how they're using the word forecast. Exactly. That's my point. It's squishy. It can mean anything. So why say it if it can mean anything? Also quoting again, quantitative measures have difficulty incorporating factors such as market liquidity or the influence of significant low probability events. Okay, everyone gets that sentence, right? That's the black swan. That's Nassim Taleb's work. They're saying right there, we don't have any way to deal with that. Just accept it. Just accept it. It's okay. We've got enough diversification. We'll never be Japan. We'll never be down 50% for 20 years or 30 years. We're 75% down for 20 years. That'll never happen to us. As I say in my newest edition of Trend Following, citing Benoit Mandelbrot, one of the first to really take a whack at the efficient market theory. Those in favor of the efficient market hypothesis, the theory, they just sweep those low probability events, the chance for the shit hitting the fan, they just sweep that under the rug and pretend it's not there. They're like kids hiding it under the bed. Oh, we're not going to talk about that. We don't have to talk about that. Just look at our returns. Look at our numbers. But we should talk about it. We should think philosophically what some of the heroes and rock stars are built on. What I love about the trend following mantra, the philosophy, the technique, it's all out there. There's no BS. There's no black box. There's no art that's hidden in the closet that only the high priest can see. There's none of that. There's uncertainty. There's risk. There's just not knowing. But there's an honesty with that. Versus when someone tells me returns and correlations are difficult to forecast. No kidding. Or ignoring the idea of a low probability event. Well, that makes a lot of sense. So as much time and energy has been put forward in the last decade, since the dot-com bubble, to think about and prepare for low probability events, the superstars, they just say, you know what? It's a one line in our annual report, and we dismiss it. Move along, folks. Don't think about it. Let me add a little more detail here. This is a interview or a presentation that Robert Shiller, Nobel Prize winner, a behavioral guy, and Swenson made at, I believe, Yale. This is quoting Swenson. I'd like to talk about how it is that we got from where we were in the mid-1980s to where we ended up in the early mid-90s and where we remain today. And to do that, I'd like to put in the context of the basic tools that we have available to us as investors. And these tools are the tools that you can employ if you're managing your portfolio as an individual, or the tools that I have to employ when I'm managing Yale's portfolio as an institutional investor. And there are basically three things you can do to affect your returns. First of all, you can decide what assets you're going to have in the portfolio and which proportions you'll hold those assets. So that's the asset allocation decision. That sounds perfectly fine to me. I mean, I don't want you to think I'm completely crazy here. That's normal operating boilerplate stuff. Swenson continues. How much in domestic stocks? How much in foreign stocks? How much in real estate? If you're an institutional investor, how much in timber? How much in leveraged buyouts? How much in venture capital? The fundamental decision of how it is that the portfolio assets are allocated. Before I continue with Swenson's comments, think about that last sentence. The fundamental decision of how it is the portfolio assets are allocated. Portfolio assets are allocated. That means everything is long only? That means you just buy and hold on? Portfolio assets, that's the strategy? What the hell's the strategy? What's the trigger to get in? What's the trigger to get out? This gets back to the fundamental foundation of preserving your capital. And look, I'm not sitting here trying to tell you that Yale doesn't have a fantastic track record except for that little financial crisis a few years back. They do. But do you like this logic? Do you like the logic that everything is just an asset that you hold long? And the how that you move around and make changes? That's the art. That's the something that's wholly dependent on the one individual. Shouldn't there be more Yales? Shouldn't there be more Swensons? Why are there so few? Why is he held out as the one? Why for over a decade have I heard survivorship bias thrown out at trend following traders, but not at Yale? Just some food for thought. Continuing with Swenson from the interview with Robert Shiller. The second thing you can do is to make a market timing decision. So if you establish targets for your portfolio, targets with respect to how much in domestic stocks, how much in domestic bonds, how much in foreign stocks, and then because in the short run you think that, let's say domestic stocks are expensive and foreign stocks are cheap, you decide to hold more foreign stocks and less in domestic stocks. That the short-term bet against your long-term targets is a market timing decision. And the returns that are attributable to that deviation from your long-term targets are the returns that would be attributable to market timing. I assume the market timing is the art. That's the secret sauce held away. But I don't think his market timing, his thought process there, is anything like a trend-following market timing. Nothing resembling the idea of using a moving average to assist. There's something else going on there. Let's dig a little bit deeper and look at it from some criticism. Barron's has criticized Yale in the past, and Swenson responded. Swenson says, let's revisit the criticisms that Barron's leveled at the Yale model and the Swenson approach. First of all, they talk about diversification failing. And the fact is that in a panic, only two things matter: risk and safety. I saw this in 1987, saw it in 1998 with the collapse of long-term capital, and saw it in 2008 in a way that was even more profound than in 87 and 98. Investors sold everything that had risk associated with it to buy U.S. Treasuries. Safety was all that mattered. And of course, in that narrow window of time, diversification does fail. Yeah, diversification fails if your strategy is essentially one big index. But let's don't let time or history obscure the fact that during this exact time period where he's talking about diversification failing, it failed for his strategy. It didn't fail for all strategies. His type of diversification failed for that type of time period. The quote, low probability black swan, which frankly happen a lot more regularly, as he just says, 87, 98, 2007 to 2009. That's not exactly the 100-year flood. But if you look at trend following during those same time periods, 1987, 1998, 2007 to 2009, trend following made a bloody fortune from diversification in a different way, from strategy in a different way than Swenson. Find me a trend following trader that looks back at 87, 98, and 2007 to 2009. Find me a trend following trader that goes, those were the worst time periods ever. Low probability events. We couldn't handle it. We couldn't have a process to deal with it when the unexpected happened. They don't say that because they made so much money, they can't count it. The point of this podcast is not to say that what Swenson does is wrong. The point is not to say he doesn't have a good strategy. That strategy looks damn good on paper. It's made a lot of money. The point of this podcast is to look for holes in the argument. When someone starts talking about art, black box. That's the black box, not trend following. When someone starts saying that you can't have a quantitative approach to investing or trading, red flag should go up. When there's no process, when there's no system in place for dealing with unexpected, low probability events, the second red flag should go up. You should be waving both red flags, going, something doesn't sound right. Something doesn't smell right. And that is the thrust of my newest edition of Trend Following. My newest edition of Trend Following expanded to 230,000 words from the last edition of 110,000 words. And that last edition probably had 40,000 of those words cut. So essentially, you've now got a 230,000 word manifesto to give you all of the food for thought that you need to wonder about Swenson, to wonder about Yale. Not to necessarily say they're all bad or anything like that, but to put down as a marker, as a flagpole of the alternative. Go back to my podcast episode 546, 548. Both of those episodes lay out in detail this new work. Why you should consider this new work, even if you owned an old copy. I mean, someone's been asking me that question every day for a few weeks now. Hey, I have the original copy of Trend Following. Why do I need this one? Now, I guess that's my burden, right? I put a basically new book out with the same title. But it's a reboot. It's an update. It's an expansion. There's 7 interviews in there. Fabulous. The research sections contributed by some of the best practitioners in the world. Awesome. So if you're up for a fire hose to the mouth education, pick up my newest edition of Trend Following and then read everything you can on the Yale Endowment. And if you want the Yale Endowment report, the PDF, drop me an email. I'll send it over. Take those two documents, my book, the Yale Endowment Annual Report, compare them, contrast them. Find the good and bad in both. But don't pretend for a second that it's a level playing field. Don't pretend for a second that the system, the powers that be, want you to understand trend following. They don't. They absolutely 100% don't. The system, the matrix, what you're currently hooked up to, the feeding tube that's currently crammed up your keister in the matrix, pushing it into you, wants one thing. They want you in a passive index fund until the day you die. They want you arguing and debating as you eat 6 pizzas a day about free healthcare. They want you to do any damn thing to get distracted while you as a body is used as an empty vessel for fees. Don't get me wrong. I want my fees too. I'm a capitalist. But I'm easy. I feel like I do the research, I do the homework, I give value to my clients, I give value to my readers. There's a price. You can accept it or you can reject it. But I'm not siphoning you blind for your entire life. I'm not putting you into a discombobulated state of nonsense where you refuse to ask questions and all skepticism has been lobotomized from your mind. No, this is a fight. It's a fight on a lot of fronts. It's really, at its root, a fight against skepticism. The powers that be don't want you skeptical. The powers that be do not want you to see outside the box. I am not trying to tell you that trend following is the greatest thing since sliced bread, but I am trying to tell you it's patently absurd that anyone or any operation should want you to not consider what trend following brings to the table. Because when you got the best of the best in the normal so-called passive index world, the normal fundamental world, the David Swinsons of the world, when you have those kinds of guys saying, well, forecasting is hard. What's not hard? It's impossible. When you have those kinds of guys saying, well, black swans, we don't know what to do there. They might happen. We don't really have a plan. Pause. Hit the pause button. Ask some questions. Do some homework. There are some great alternatives out there. There are some fantastic ways to make money. And I hope like hell that when you go through my newest 700-page edition of Trend Following, you will see those obvious contrasts in very clear light. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.